So recently, the Central Bank of Nigeria adjusted its monetary policy parameters. And today I will break it down, and explain what each of these parameters actually mean. The four key parameters that you see after they announce every change, there are four of them. The first one is MPR. MPR stands for monetary policy rate, right? The next is CRR, which is cash reserve ratio. The third one is LR, which is liquidity ratio. And the fourth one is SFC, which is standing facilities corridor. Now, let's start from the monetary policy rate, which is MPR. The current rate is 26.5%, and this is the base rate. This was cut down by 50 basis points, which is same thing as 0.5%. What this simply means is that borrowing may slightly become cheaper, and businesses and individuals should just, expect a slight, reduction in their interest rates going forward, just slightly. So the second item is the cash reserve ratio. The current ratio is 45% for commercial banks. And what does that mean? It means that bank must keep 45% of their deposits locked with central bank, meaning that they don't have access to that to do anything. And this actually helps to control inflation, but it also means that banks have less money to actually lend to customers. So for instance, if a customer brings 100 naira into the bank as deposit, it is required that 145 naira out of that 100 naira has to be kept with the central bank as cash reserve ratio. All right, so the next item that you see on the policy change actually is the LR, which is a liquidity ratio. It is currently 30%, right? Banks are required to hold a portion of, the liquid assets, which is 30%, like cash or government bonds. And the reason for this is to ensure that they can pay customers on demand. And this is the reason why you can go to any bank today and you get your money, because it is required by central bank that a certain percentage of their asset has to be kept, in a liquid asset that can easily be converted into cash. And this keeps the system very safe and also very, very stable. So the last item is the SFC, which is standing facility corridor, and is currently around 50 plus 50 basis point minus 450 basis point. And this is a safety window around the MPR, right? MPR, that is on the extra fund that has been kept with the central bank. So what this helps to do is that it keeps the interest rate very steady and also avoid fluctuation. All right, so borrowing might get a bit easier, but the CBN is still very careful to control inflation. Stability is... So what do you think? Does the 26.5% make your borrowing easier? Please comment below. Thank you for watching, and I'll see you again in my next video.